Good morning, good evening, good afternoon. Welcome to another session of Bizarre Financing. I'm Gordon Bizarre, and today we're going to cover two exciting topics. One is how to hang on to the seller's cash and how to avoid good faith deposits and earnest money. I don't know a single business buyer who hasn't faced two challenges that these directly apply to. And so we're going to try and keep more money in your pocket today, reduce significantly the amount of money that you have to acquire a company. I know many of you are going to have questions today, so just type your questions into the comment or question box on the right side panel. And if you can raise your hand because you want to talk live, I'd like to do that because I find I can answer questions much better that way because we can dig down into the questioning, really get to the root of it and a more detailed answer. Any unanswered questions, just send me an email to question@bizarrefinancing.com. Happy to answer them by email if we don't get to your question today. All right. Hanging on to the seller's cash. Okay. Just because the money is sitting in the company bank account doesn't mean it belongs to the seller. That's a hard concept for some people to get around their head around, right? Because if it's in the seller's company and it's cash in the bank, that's the seller's money. It's not. Let me explain to you why. If they want to sell their business as a going concern, they cannot take the cash out of the company. A partial list of the reasons why include customer deposit. So in that bank account, they may have customer deposits where the customers put up the money for something that's going to get delivered later. If they sell the company to you and you have to deliver a product late, but they've taken the money that the customer has paid for the product, you can see where that's a little problematic because when that product comes in, you have to pay for it, right? So the customer deposit is there and it belongs to the customer, not to the seller. Deposits from renters. If they rent real or personal property as part of what they do in their business, any deposits from the renter are due to the renter. Okay, they're money of the renter that's on deposit there. It's not the seller's money. And they can't take that out of the business when they sell it to you. Many businesses, if they're well run, have a sinking fund to replace aging equipment. The whole idea of a business is that your equipment depreciates over time. It reduces in value. And the company has lost that asset in terms of its need for future production. So appreciating and then finally it gives out or it's obsolete or something happens to it that it now has to be replaced. Right. Many companies that are well managed have a sinking fund with money in the sinking fund so that it sinking fund is increasing so that at the point that the equipment has to be replaced, the money's there to replace it. That's the smart and intelligent way to run a business, which is the way you're going to want to run it. And so the concept here is any money in a sinking fund to replace aging or obsolete equipment that belongs in the business to do the purpose for which it was saved for or put there for. It's not the seller's money to take out. The contingency reserve fund. Again, a well-managed business always has some money that just sits there as a contingency, as a reserve in case crazy things happen, because crazy things happen. Crazy things happen to the seller in his or her past experience in business, and crazy things are going to happen to you when you own and run that business. And so money that would be sitting in a contingency fund doesn't belong to the seller. It's part of what makes the business safe and sound to run. Okay, so I hope we're getting clear why that's not the seller's money sitting in the company. Payroll withholding tax. Some of that cash may be sitting there because the company has withheld taxes and other withholdings from the employees. And there's going to come a time in the very near future where that payment is going to have to be made to the government. It's not the seller's money. It's the company's money that is holding for employees that belongs to the employees because it's their withholding that's going to be paid over to the government. Withheld sale taxes, same thing. It's not the seller's money. It's money that's there because there's a sales tax bill coming soon or more soon than later. And that money has to be there. It belongs to the state. It belongs to whoever that tax is due to. It doesn't belong to the seller. Accrued taxes on property. When you buy a company, let's say it owns its own real estate or it's got a triple net lease, which means it's responsible for paying the taxes on the real estate. So that money is accrued because the tax bill is due at the end of the year or at a certain point in time. And during that period of time, money's being set aside so that when that tax comes due, it can be paid. So whatever the accrued taxes are on that property belong to the owner. It belongs to the city or belongs to the county. It belongs to whoever it is that collects that taxes on that property. A lender requirement. Many times you will have a lender in a business who insists that you keep a certain amount of cash on hand at all times because that's part of the terms and conditions of their loan. They want to make sure you're liquid enough that when their loan payment comes up, you're going to be able to pay it. It's part of the terms of the loan, and it's not the seller's money. It's there to fulfill a condition of the business. Many times you will have a bank that will make you a loan or a credit line or whatever it is, but they'll insist that you keep what's called a compensating balance with the bank. It's a condition of the loan. It's part of how the bank makes money on your loan because they're, in effect, when you have that compensating deposit, they're earning interest on loaning you money that you have to keep on the account without earning interest on it in their bank. Okay. But it's part of the conditional loan. It doesn't belong to the seller. Reserved for bad debts and write-off. Okay. Every company that I know of has them. There are people that don't pay. If you have customers, that everybody's going to pay you. It's just the way life works, unfortunately. So an intelligent company keeps a reserve knowing on an annual basis how much stuff is going to get written off. And they keep a reserve for that so that they don't run out of money because people didn't pay on their accounts payable. So again, that reserve, based on the business's history and the need for a certain amount of that money, that's not the seller's money. It belongs to that run going concern business. Hopefully you're getting the picture here. Working capital. Okay. A business requires working capital to operate. You can't run a business without working capital. Now remember, the seller is pricing the business to you as a going concern. He's not pricing it to you on the value of its assets and they're going to sell it to you for a net asset value. It's a going concern. It has a goodwill value. In order to have the goodwill value, it has to have working capital to function. That's not the seller's money. It belongs to the business in order for it to be a well-run business. And as a result of that, the working capital has to be there because without working capital, you didn't buy a going concern. So you priced it as a going concern. The working capital has to stay in the business. If the seller takes out the needed working capital, it is no longer a going concern and loses its going concern value. Excuse me. Reserve for contingent obligations like returns, warranty exposures, corporate guarantees, etc. Okay. If the business guarantees their product and periodically they get people sending their products back on that return, the customer has to be given back their money. The same thing on a warranty. The same thing if they have a corporate guarantee where they may have guaranteed somebody else's loan. You got to look for all these things. But if any of these things are true, then whatever money is allocated for those purposes there, that's in the company's bank account. I'm sorry, it's not the seller's money. It's an obligation of the business and it belongs to whoever they have to pay it to when these conditions are triggered. So the seller can't take that money out. It's got to be there to meet those obligations. The reserve for unfunded liabilities to the company's retirement plan. Many times the company will have a retirement plan and the amount that they contribute to each employee's account is almost always not enough to pay for their retirement when they get to their retirement age. And what the company will do when that employee gets to retirement age is they will take and continue to put money into that account after the retirement to pay for the retirement because the retirement account wasn't fully funded to the level of obligation it has to the employee. So if that's the case, then any of that unfunded liability to the company's retirement plan, which can be sometimes hundreds and hundreds of thousands, of a big enough company, it can be millions of dollars. That's not the company's money because they owe it. And it's not even on their balance sheet. It's something you have to dig out and do diligence. But whatever that amount of money is that it's going to take to fully fund the retirement of that employee, remember, that's money that is owed by the business, not from when you own the company and on forward. You'll have your own issues with funding that retirement, but that's money that's owed based on the employee having worked for the company before you own the company. So you're not taking over that obligation unless you voluntarily take it over. But the point is, whatever money is sitting in the company's account, looking at what that unfunded liability is, that's not the seller's money. It's the company's money and it has to stay in the company in order for the company to be a sound operating company. Number 13, required to cover low season's negative cash flow. Many businesses have a busy season and then they have a slow season. During the busy season, cash comes in like crazy. During the slow season, they may not have enough cash to cover overhead. So they take the money that they put into the bank account while the season was for high sales, for their high sale season. But if you take that money out, how does the company survive the low season? So that money has to be there and it doesn't belong to the seller. It belongs to, if it's a going concern, it has to be there to cover that negative cash flow in order for the business to survive to the next busy season. Number 14, rainy day fund. The seller knew he had to have some money in reserve for that rainy day when who knows what's going to happen. That money and liquidity has to be there in order to have to run this business safely. You will get rainy days too. And when you own the business and when that happens, you're going to need that rainy day fund there too. So if he's selling you a well-run business and that's why you're paying the purchase price that you're paying, then the rainy day fund belongs to the company because it's part of how the company has sustained itself and is well managed, which is why you're paying the price for it that you are. Number 15, required to handle a rapid gear up coming into the busy season. When you come into your busy season, ahead of the busy season, you got to hire employees. You got to hire more employees. You may have to rent and lease more equipment in order to get it out. You may have to take on additional warehouse space for that period of time. And you got to do all of that ahead of the busy season. So while you're coming out of your slow cash period and now going into the rapid buildup, you got to have the cash to do that or you're not going to be able to have the great busy season. That is what propels that business and its growth forward. So that cash doesn't belong to the seller. It belongs to this well-run business that they're selling you. Number 16, exposure to seller's potential undisclosed liabilities. I will guarantee you that a seller will never tell you about more liabilities than they actually have. If anything, not for any reason that they're trying to even defraud you or mislead you in any way. Every time I've ever seen a business that's been transferred, there have always been undisclosed liabilities that were in the company that maybe the seller didn't even know existed. Okay. But if the seller is pulling cash out of the company when he delivers it to you, it's not the same company that would be there as a successful company in order to handle the exposure to those undisclosed liabilities that the seller didn't tell you about. So it's another reason why cash in the bank is not the seller's cash. Okay. I think you're getting the point. We're going to go on for a little while here. A key component for funding the growth trajectory, which is part of how the business has been valued and priced. In other words, let's say the company's growing 20% per year. And that's why you're paying the multiple of EBITDA you're paying for this business, not because it's a static business and doesn't grow, but you're paying the multiple that you've agreed upon because you're buying a company that is going to grow 20% per year. A business that grows 20% per year, for example, has to have a certain amount of money to pay for that growth, to hire new employees, train new employees, rent more space, buy more buildings, carry more inventory, carry more accounts receivable. All of those things have to happen and they require cash. So a business that's growing has to have more cash in it than it needs to pay its current bills because the trajectory of growth is going to be commanding that more and more money is applied to growth. And if it's not in the business, it's not going to grow. So if you're paying that multiple of EBITDA because you're buying a growth business and the seller pulls this cash out of the company, he's pulling out of the company the ability to do what you bought it to do. So it's not the seller's money. Hope you're getting clear. Vacation and sick pay accrued to employees. He may have employees there that didn't take vacations for the last 3 years. All right. And the company owes them all this money. Okay. Now, granted, when you own the company and the employee comes to you and says, look, I've got an accrued vacation here of 2 months and I'm taking it now, who has to pay the employee while they're not working and producing for the company? You as the new owner. And if the seller takes the cash out that is accrued for these purposes, then the business is going to lose in the future that cash. And it's not their cash, the seller's cash, because it's sitting there in the bank account because it's got to be used for this purpose at some point and probably the not too distant future. Number 19, exposure to government penalties, fines, and back taxes. All right, let's take a certain type of business. Let's say you're a plating company. You plate metals. You do metal finishing, and you plate these products of other companies. They bring in their product. You have these big vats with chemicals in them and electrodes and all that stuff. And you put a nickel plating or different types of plating, gold plating, whatever it is. You put it onto their products. All those chemicals are an environmental risk. And it's not unusual for after a company is sold, the government can come in and say, this company has been polluting this area with all of these chemicals for all of these years. We've tested your soil around the plant. And guess what? You have to take care of all this environmental pollution. And not only do you have to pay for that, but because your company did this, we're going to charge you a penalty and then a fine. All of those things have to be paid for by the company. So it's an exposure. And it's part of the reason that the cash that's in the company doesn't belong to the seller, because if this exposure exists, there is a possibility and a strong possibility that the company may have to pay that. And we don't even know what it is. That's unseen. You don't know what it is until it physically happens. Almost every company has the issue of back taxes. Let's say the owner didn't report their taxes properly for the company. You may be liable for that, as the company is the same company. The fact that it's not the same owner is irrelevant. The company still owes the back taxes to the government. And it's another claim on the bank account of the company, which is saying to me as the buyer, and it should be saying to the seller, sorry, seller, this is not your cash in this company. Okay. It belongs to all of these reasons that we've been giving you, plus these exposures. So I'm sorry, you cannot take the cash out of the company. And one more here, exposure to lawsuits. For anything and everything, some lawyer might concoct a claim against the company for issues occurring prior to the acquisition. So here it was, you had nothing to do with it. The company is being sued for something that you didn't have anything to do with, but now it's your cash in that company that has to pay for all this. So it's another reason to say to the seller, sorry, you can't put your hands in here and take this money out. Because if you do, it's not the going concern with a viable business. That is the reason I'm paying you this multiple of EBITDA for the purchase of this company. Now, believe it or not, there are more, but I hope you get the point. And think of it this way. Take a major corporation A. Major corporation A buys major corporation B. Okay. General Motors buys some auto parts manufacturing company. Okay. The owner of B, whatever that company was that the big company bought, they do not get to take any cash out. They don't get to take any cash out. I'll guarantee it. B comes as is on the basis that its cash is necessary for B to conduct its business. If A wants to take cash out of B to offset part of its acquisition costs, it's within their discretion to do. They're the buyer. All of that stuff now does belong to them. It's good, bad, and it's ugly, but they can make the decision to take the cash out to help pay for the acquisition. And in fact, that happens more often than not. When any big company buys another big company, they suck cash out of the company to reduce their cash expenditures, knowing that any of the things that cash was there for and should be there for, they're going to have to contend with that down the line, but it's their company now. So they've just made the decision to deal with that down the line and soften the cost of the company now by pulling a good portion of that cash out. So hope that makes sense to everybody. And so if the seller argues that these are surplus funds, in other words, oh, I got all this money in the bank and it's surplus, the company doesn't need it, it belongs to me, I'm taking it out as before I sell you the company. So if that's their argument, then your argument is if the funds are surplus, the owner would have taken them out long ago. If they aren't taking them out, it's because they know that those funds are needed there. And since they didn't, and you don't know the operating needs of the business, the cash must remain. And that's your argument. And your argument is backed up by all the things that I just went through with you. Your assumption must be that the seller knew what they were doing and left the cash in the company on purpose. If the business is a corporation, this is just another reason. If the business is a corporation and the seller distributes any of the cash to him or herself, it is considered ordinary income and taxed at the highest marginal rate. So the downside of the seller pulling that cash out is they're going to pay ordinary income on whatever that distribution is, right? And the chances are they can't take it as salary. So it'll have to come out as a dividend, okay, which means it's double taxed. The business will owe a tax on it, whatever the profit of the business is, but all that money that came out will be taxed again as earnings ordinary earnings of the seller. If they leave the cash in the business, it has been included in the purchase price and it is taxed as capital gains. Anything the seller gets from the sale is long-term capital gains, much lower tax rate. Okay, much lower tax rate. And so the common sense of any transaction, whenever you make your final deal with the seller, is for the seller to leave the money in the company and just be satisfied that they're getting the purchase price for the business that is the true value of the company. But the cash should be left in the company, not distributed to the seller. Now, hopefully, I've made this argument soundly for you. You're going to have the opportunity, of course, in the future to review the videos here and to rethink this through and to put all these pieces in place for yourself and get a mental command of the rationales and the reasons here. But I never have sellers pulling cash out of their company. Never, because I go through this with them and they can't argue with a single item. It's all real. All right. There's more to this webinar today, but the topic's going to change. So my question to you is, do you have any questions before we go on to the next topic? And what I'd like you to do is to raise your hand or just type a question into the question box and we'll try and get to it. I see one in here. When will this recording be in the portal? Oh, we're doing these very quickly. We've actually been better at getting essentials done than pro. So it should be within 2 weeks. I need to put this in a written document and unscrupulous brokers. Absolutely. Absolutely. In fact, we will not only be posting it, but we will add a download to it where we'll have a document that goes through all of the logic that I just described to you for presentation to sellers and to buyers when they get hung up on it's their cash. No, it's not your cash. And here's why. And it's a very powerful argument. All right. Any more questions before I move on to the next one? Great question, by the way, Darrell. Very good question. All right. I don't see any more. And by the way, at the end, if you do have a question here, you can feel free to ask it and I'll be glad to cover it. All right. That being the case, let me see what happens. We get rid of that. All right. Let's go on. All right. The next topic we're going to cover here is avoiding the good faith deposit. How many of you have looked at buying a business and the broker says, we want you to put up a good faith deposit or an earnest money deposit? Has anybody ever had that request? I'm not going to ask you to raise your hands because if I did, every hand of anybody who's tried to buy a business, it would be up. Okay. It's a very common thing. And why does the broker ask for that? Because they want to lock you into the purchase as much as they can. They want to know you have cash and that's sitting in the bank because that's what pays their commission. All right. So we know a lot of why it happens, but let's address it and look at the arguments pro and con, because I do not put up good faith or earnest money deposits. Never have, never will. And I bought a lot of businesses. So there must be a way around this, right? Excuse me. Here we go. Okay. Why do they do this? They want proof you're serious. And since they are taking their business off the market and foregoing other opportunities, okay? So they want to feel like you're serious. They're going to take their business off the market and they could lose another opportunity. There could be another buyer right behind you. And if the business is tied up because it's being purchased by you and you're going through the whole process, they don't want to think that they could lose something. So they want to have a good faith deposit or earnest money to ensure that you are serious about this and that you actually have cash. All right. The fact that you may not have the cash to post the deposit is actually not the primary reason to decline this. Although if you don't have the money, you have to decline it, right? Because you don't have a choice. But that's not the reason. The seller is not the party most at risk if the transaction doesn't close. It is you, the buyer, that needs the protection more so than the seller. And that's what I'm going to show you and take you through right now. If anything, the seller should be posting a good faith deposit to protect you. And I'm going to prove that to you in the next few minutes. First, you're going to try to negotiate with the seller to forego the deposit. Okay. So you're not going to tell the seller, I don't have the money. I can't give it to you. Right. You're going to want to negotiate with them to forego the deposit. And here's how you do it. Here's how we're going to go about it. And by the way, you may want to pass on the deal that require good faith deposits or earnest money. So any deals that require it, you're going to want to pass, and I pass on them because I have a certain attitude towards business, and you'll see it in a moment. All right, let's start with negotiation. To negotiate away the deposit, you should first understand the nature of the deposit and all its implications. the rationale against such deposits in business acquisition, and the origin of the earnest money and good faith deposit. Where did this thing even come from? How did it even get in existence? Where do good faith and earnest money deposits come from? Okay, let's answer that question. I should have had a question mark there. Most business brokers are licensed as real estate brokers or agents. Almost every state in the United States, there's no such thing as a business broker license. It's a real estate license for either a broker or an agent. And under the real estate license comes their ability and their license to sell businesses. So it's part of a real estate license. Now, why is that significant? Because these good faith deposits and earnest money, these things are a carryover from the way real estate is purchased. But there's a big difference, okay? In business acquisitions, unlike real estate transaction, the common practice is not to require a good faith deposit, where in real estate, that's the prevalent way that things are done. It's just part of the deal. Everybody knows it. Everybody's prepared for it. They just do it. And it's built into real estate. But it's not a best practice when it comes to business acquisitions. Here's why. The difference is a real estate purchase is relatively simple. You inspect the property, obtain a professional appraisal, negotiate the deal based on the appraised and the inspection, and then you put up the money and fund the deal, however you're going to mortgage it or whatever you're going to do, and then you close the purchase. It's simple. And everything is known before the seller has to tie up his property. The buyer can see everything before tying up the seller's property, where the only thing left is arranging the financing. So a lot of times your deal is contingent upon getting the financing, but you don't mind putting up the good faith deposit because it's a cut and dry situation. The property is what it is. The seller can't really hide anything. If you've done an inspection and you've had a good appraiser appraise it, the contingencies are very nominal, if any. You know what you're going to get. You're clear. Compare that to the complex and extensive due diligence required to assess a company's operations, where you must rely on the representations of the seller until way into the transaction, when serious due diligence is completed. So if they're asking you to put up a good faith deposit and you don't even know what's really in the company, and all you have is seller documents, seller representations, you see the difficulty with that? You see why that's not appropriate to ask you yet to put up anything? The intricate review of financials and operations, largely based on the seller's representation, is both time consuming and costly to you, the buyer. Costly. Moreover, this process often reveals discrepancies, introducing significant risks for the buyer. Now, why do I say this thing is costly? All right. You got to go in and check his inventory. That means you may have to hire somebody who is an inventory specialist who will go in and count up all that stuff for you and tell you what's there and what's not there. You may have to have somebody come in and do a quality of earnings report on the way that their statements are presented. And that can cost you 40, 50 grand. This is cheap stuff. Okay. You have all kinds of expenses in validating what the seller has represented to you. Not like real estate, where it's a physical thing. It can be appraised and it can be inspected. And then you know what you got. You don't know what you got in a business until way down the line when you've done extensive due diligence. And it's very expensive getting there. Compare this to the seller's risk of opportunity loss while their business is off the market. They do have that exposure. I take my business off the market, right? There could be a buyer who comes in right after you and says, hey, I'll pay even more for this business. That's a risk that they take, absolute risk that they take. But remember, their business is still operating, making profit, impeded by due diligence, negotiations, agreement drafting, and the closing process. In other words, for them, whether you buy this or not, the business is going on like nothing happened. So they're not losing anything on the business. And if it's a profit-making business, they're still making money. Okay. So there's no risk or damages to them there. The only risk they have is maybe losing the sale because you didn't close and they missed somebody else in the meantime. So they do have one risk, but the business is not a risk. It's still going on. If the transaction is not consummated, it is the buyer who has borne the burden of most of these excessive costs and the opportunity loss from the investment of their time. Just like the seller has a loss because his building didn't get sold to somebody else, and that's a risk. You have the same risk while you're investigating this business and doing what you have to do to acquire this one. You can't acquire another one either. So you have that same risk, but you also had all these upfront expenses that you had to cover to validate the seller's representations about their business. Because remember, it's just a business. You walk in there, people running around doing their thing. The seller gives you papers that say it's making this much money, but until it's validated, you don't know any of that is true. You don't know what this company is making. You don't know what liabilities it has. You don't know any of that. And you've got to have a costly exercise in order to validate all of that. The seller doesn't have anything like that. Only you, the buyer, have that. So here is where the argument arises that the seller should post a good faith deposit to protect the buyer from adverse elements not disclosed upfront by the seller. I've turned to sellers when they were insisting on a good faith deposit to protect them. I said, wait a minute, you should be protecting me. I have to have this expense. I have to rely on your representation. It's going to cost me all this money to check that out. And if I check it out and you misrepresent any of this to me, you should be putting up a deposit to protect me. You can imagine what reactions I get to that. But it's true. Requiring a deposit only from the buyer would also create an unfair negotiation disadvantage for you. And the reason is such a scenario risks skewing the balance against the buyer's interest as the definitive purchase agreement is being finalized. And the reason is that deposit you've put up becomes leverage against you. You're out this money. It's in the hands of strangers. Maybe they're going to give it back to you and maybe they're not. Okay, maybe they're going to come up with a reason why you violated something and you're not entitled to your deposit back. And maybe you've put it in the hands of an independent third party like an escrow company. But depending on those escrow instructions, you may not get it back. In fact, usually once the deal falls through, the only thing left to fight about is who gets the share of what of the deposit money. What's your money? You don't want everybody fighting over your money. Okay, so that's one of the reasons I don't put it up. I don't want to be in that position. I don't want it being used as a lever to cause me to be acquiescent on terms that are important to me in the definitive purchase agreement. So these are some of the reasons. The acquisition process inherently involves both parties investing time to meet and evaluate each other's credibility and good faith. And this is what I tell the seller. Look, we're going to spend time and we're going to get to know each other here before we start throwing money around. Okay, you're going to get to know me. I'm going to get to know you. I'm going to see if I like you, trust you, and respect you. You're going to see if you like, trust, and respect me. I know I'm going to try and build a cosmic bond with that seller. And over the course of building that cosmic bond, the chances are pretty good that everybody will agree. You don't give me a deposit. I won't give you a deposit. We're just going to go ahead, good faith, and make this work because we like, trust, and respect each other. So that's where you're trying to get to. This mutual assessment forms the basis for each party to absorb their respective transactional risk. Sorry, seller. Okay. Transactions have risks and all the risks don't belong on me. We need to share them. Okay. You're going to accept your risks of maybe not selling this business to somebody else. Okay. And I'm going to accept my risk of the expenses it's going to cost me and the time loss I'm going to have and the opportunity loss I'm going to have while I'm working to acquire this company and putting my time and my money here. Okay. I'm going to absorb my risks. You're going to absorb yours. And we're going to do that because we have some good faith with each other. Okay. So that's the logic. Your argument, after meeting the seller, I'm ready to proceed, confident in the mutual good faith and understanding established between us. And you're going to tell them that, look, I'm ready to go ahead. I trust you and I need you to trust me. I hope the seller shares this confidence and is equally prepared to advance. By not requiring deposits, we align with industry standards. This is the standard in the industry. The standard in the industry is not good faith deposits and the like. It's the standard in the industry is that you don't do this. Everybody takes on their own transactional risks. And that's what everybody does in this business. Now, there are those brokers and those sellers that are schooled in this good faith money psychology. That it's part of their business. They want to lock in the seller and they figure those buyers want to lock in the buyer. And they figure those buyers that are ignorant enough to do it, they're going to get them locked in. But I hope my trained buyers are a little bit smarter than that. And we've equipped you with the rationale, the knowledge, the logic, the reasoning, the negotiating lynch points for how to present this so that you don't get caught in this trap of the good faith deposit or the earnest money. This practice ensures a balanced negotiating process free from undue leverage against either party's interest, where each of us assume our own transactional cost and risks. The alternative is we each post deposits to protect each other. So that's always my downside. And I've never met a seller yet who would say, oh yeah, let me put up a deposit to protect you too. Doesn't happen. It doesn't happen. And it drives the point home. So I got this risk. You don't want to protect me. I'm sorry you got a risk, but no, I'm not going to protect you. My readiness to move forward based on our assessment and mutual respect underscores my commitment to a fair and successful partnership. And I use the word partnership because when I buy businesses, I rarely buy them 100%. I have a number that I've bought that way, but I usually buy them 70%, 80%, 90%, 60%. And I do that depending on the situation, but I don't run companies. That's not what I do. I want to acquire a company because there's a great seller who's built that company, understands that company, has 4, 5, 6 good years still left in them, wants to stay active in the business, but wants to take chips off the table, meaning they want to get cashed out for a part of their business. So that's locked away in the bank somewhere. And then when we work together in a partnership where I'm going to support how they're going to grow that business to the point where I'm hoping and they'll be hoping and we'll be working together so that the 20% that let's say they retain 3 to 4 to 5 years later, I'll buy that from them at its then value. And if we've done a good job working together, they'll get more for their 20% than they got for their 80% when we first did our deal. And that's the goal. That's what we're going to have a business plan that does that. I'm going to show them how I'm going to add value to this company, the business model I'm going to bring in, the sales contacts, the finance contacts, all the things that I bring into this business are going to rapidly grow this company with them actually running operations and in control of the operations. I don't want to control that. I want them to control it. So they're going to get to control their operations. They're going to get me as a partner. I'm going to help them build the business, and their 20% is going to be worth more than their 100% was on the day I met them. And that's what I work to sell that seller. A lot of times people think I'm a buyer. No, you're not. You're a seller. Why are you a seller? Because you're going to sell the seller on the reasons they want to sell to you. You're going to show how when you're their partner and their minority percentage comes out into year 4 or year 5, they're going to win so dramatically that it's absolutely worth their doing this with you. And that they're going to have everything they want anyway, which is to continue controlling the business, continue building it with us as their partner to provide them resources to grow. So that's the sale that I make to the seller. Given these dynamics, both buyers and sellers in business acquisitions typically bear their own risk without the exchange of deposits. It's the way the acquisition and merger field works. You would not hear of General Motors putting up a good faith deposit to buy another company. You would not hear of them putting up earnest money. Everybody meet, they exchange information, they go through a defined process. They do it seriously because these companies can't just, they would destroy their reputations if they try to act in not a good faith way, although some do anyway. But the point is, nobody exchanges money until a deal closes. Now, you may have heard of a thing which Elon Musk faced with Twitter, where there was a breakup fee. In other words, he didn't put up any money, but he was responsible for a breakup fee if he didn't close the deal. I've gone into deals where there was a breakup fee, but I fully defined what would trigger the breakup fee so that it was clear. If there was even a question that it had to do with information not provided by the seller. And I went through all of the reasons why it could be a breakup. I can walk away and I don't owe anything. And I was so comprehensive in that it would be impossible for me to walk away and owe something. Okay. Because the only way that could have happened is if I walked into it looking to defraud the seller because I didn't have any intention of buying it in the first place. Okay. That's what it would have to be for me to own anything on the breakup fee. So the point that I'm trying to get to, and a breakup fee doesn't require you to come up with cash now. I want to make that clear. So that doesn't have anything to do with cash now. It would have cash that would go to the seller, provided they can establish that you did this nefariously. They have to prove that you didn't intend to buy the company in the first place. That's how strict you can get that breakup fee. This not only prevents negotiation imbalances, but also respects the unique challenges and risk inherent in merger and acquisition transactions. Okay, the reason that I'm giving you this advice is inherent in the nature of an acquisition and merger transaction versus real estate, where in real estate, it makes perfect sense. In a business, it makes no sense. All right. So that's the difference. In my case, if this negotiation fails to dissuade the seller's insistence on a deposit, I pass on the deal. Okay. I pass on the deal. Just pass. I do not fall in love with a target company until the deal is closed. I focus on creating deal flow. In other words, I focus on activities that put me in front of business after business. There's no shortages of business to buy out there. I can buy any business. The seller can only sell his business or her business. So I focus on creating deal flow. Now, why do I do that? Because that way I'm able to treat an acquisition like taking a bus. If you miss this one, don't worry about it. There'll be another one along in about 15 minutes. And that's the way I approach merger and acquisition. Don't fall in love with the company. When you buy it, you can be as much in love with it as you want. But even then, it's still a business. It's got to make money for you. If it's not performing, you can't be in love with it. You got to figure out what you're going to do with it. You're going to spin it off. You're going to liquidate it. You're going to sell it to somebody else. You're going to do something other than take the losses. Okay. You don't fall in love with businesses. You fall in love with your wife. You fall in love with your family. You fall in love with good friends that you have an agape love for. Okay. But you don't fall in love with businesses. Any questions? Okay. Jay Helmut, how are you today? I'm going to read your question here. It says, "Hi, Gordon. Obviously, a business attorney would be handy at this point. In other words, providing all of this in writing, am I correct in this assumption?" Well, you say providing all this in writing. Okay, when I'm having this debate with the seller, I'm going to put it in the terms of a debate, not an argument, just a debate. I have all my written materials that spell all this out. And I say, review this, okay? And I'll have in my documents examples of companies that it's obvious from the reporting on the company and big enough companies, these things are well reported and that they don't have these things called good faith deposits or earnest money. And here's the reason why. And it's inappropriate for you to even ask me. And in fact, it's more appropriate for me to be asking you because I'm the most vulnerable in the transaction. Okay. So that part doesn't have to be in writing. Okay. But your agreements, whatever they are, has to be in writing. But your debate or arguments with the seller, I have supporting materials, but I don't have a written signed agreement with the seller. He's not going to charge me a earnest money. Okay. So anyway, the point I'm trying to get at is the discussion either leads to a satisfactory solution or it doesn't. If it does, then there is no depositing the money. And in my letters of intent, I often put into those letters, there's a clause in there that I put in, which says, and by the way, remember, it's non-binding anyway, a letter of intent. So you're not bound by what it says there. But what I put in there is that I will not be putting up a good faith deposit or earnest money because I am responsible for this and the seller is not putting up a earnest money or a good faith deposit to protect me. So I put it right there. Okay. And that solidifies it in everybody's mind that this is not happening. Okay. That we're all working together in good faith because we all want this deal to happen if everything is as represented.